All right, welcome to The Explainer. Today we're going to dig into 5 stocks that the market might be sleeping on as we look ahead to 2026. We'll break down why there could be some serious opportunity hiding in plain sight.
After the market's been on this incredible run, the question on every investor's mind is, well, what's next? Where's the real value hiding? With everything hitting new highs, you've got to look a little closer to find those gems.
So, to get a handle on what the year might hold, some folks turn to this classic indicator from the Stock Trader's Almanac. It's called the January Trifecta, and it's basically a 3-part checklist that looks at how the market kicks off the year.
And get this, the track record is pretty wild. Since 1950, when all 3 of those things happen, bam, 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 the S&P 500 has ended the year up 90% of the time. I mean, that's a really interesting pattern. Of course, it's not a crystal ball, but still, pretty compelling, right?
But, instead of trying to predict those short-term zigs and zags, we're going to focus on something a bit more timeless. We're talking about finding really high-quality businesses that, for whatever reason, look like they're on sale. Great companies at great prices.
Okay, so here's the game plan for today. First up, we're diving into the big leagues, tech and energy, to see what's brewing there. Then we'll shift gears to some consumer stocks you might use every day, but are maybe overlooking. And to tie it all together, we'll finish with the Value Investor's Playbook.
All right, let's jump right into our first section. We're looking at 2 huge sectors, tech and energy, where some, let's call them unique pressures, might be creating some really interesting opportunities.
So first on our list is Chevron. Now the stock has taken a hit because crude oil prices have been dropping, right? They're hanging out near the lowest they've been all year. And for a lot of people, that just sounds like bad news, plain and simple.
But, and this is the key insight from our source material, this is exactly when an opportunity might pop up. Think about it. Energy is a cyclical business. It has big ups and big downs. The real money is often made by buying when everyone else is pessimistic, not when the party's already raging.
And when you look at the numbers, you can see the financial muscle here. They've made some heavy investments that are expected to pump up their free cash flow to over $20 billion by 2026. And on top of that, it's a dividend aristocrat. That's just a fancy way of saying they have a rock-solid history of raising their dividend year after year. Right now, that's giving shareholders a nice 4.5% yield.
Okay, let's switch gears completely and talk about a tech giant, Meta Platforms. To me, this is a textbook example of a company where the underlying business seems a lot stronger than what its stock price might be telling you.
So let's talk valuation. Meta is trading at a forward PE ratio of just 22.5. Now, for anyone new to that, it's just a way investors measure if a stock seems cheap or expensive compared to how much money it's making.
And what's really wild is that makes it the cheapest stock in that whole magnificent 7 group of tech giants. The cheapest. All while it's just printing enormous amounts of cash.
So here's the bottom line. This isn't about making some wild bet on the metaverse. No. The real play here is owning the absolute powerhouse advertising business that runs Facebook and Instagram right now. I mean, you've got billions of users and millions of advertisers all in one place. That creates this incredible feedback loop that's just almost impossible for anyone else to copy.
All right, let's move on. Now we're going to look at some companies that are probably a part of your everyday life, but their potential as an investment might just be flying under the radar.
Let's talk about Netflix. For the longest time, the whole story was growth, 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 right? Spend whatever it takes. But they've totally flipped the script. Now it's a cash-generating machine. But here's the thing. It's trading way cheaper than its historical average. It's like the market hasn't quite gotten the memo about the new Netflix.
Okay, our next stock is AutoZone, and the entire story really boils down to one number, 13. That's the average age of a car on the road in the US right now, an all-time high, by the way. Think about that. And that quote just nails it, doesn't it? The thesis is simple. Older cars break down more. They need more parts. And that is fantastic news for a company like AutoZone. It isn't some flashy tech stock. Nope. It's what you'd call a boring business that just quietly keeps chugging along, making money whether the economy is booming or busted.
And for our last one, let's talk travel with Booking Holdings. Now, this company could be sitting in a real sweet spot, with a bunch of economic tailwinds potentially coming its way. We're talking about things like possible interest rate cuts and maybe even some big tax refunds, which means more money for people to spend on vacations.
And here's the kicker. All of that would be pouring fuel on an already super efficient fire. Look at these margins. Both profit and free cash flow are over 32%.
In simple terms, that means for every dollar that comes in, they are incredibly good at turning it into pure profit and cash. That's the sign of a seriously healthy business.
So what does an oil company, a social media giant, and an auto parts store all have in common? It seems random, right? Well, it all comes back to a really clear and simple playbook for finding value.
The core strategy here isn't about diving in headfirst. Not at all. It's about patience. It's about looking for those moments when a great company's stock takes a temporary hit. And most importantly, it's about sticking to the fundamentals, what the business is actually doing. And that really brings us to the end. We've looked at the against-the-grain play with Chevron, the powerhouse cash machine that is Meta, and the boring is beautiful story of AutoZone. Each one is a totally different flavor of hidden value. So the question I'll leave you with is, which of these stories grabs you the most?